Hello, welcome. This is Dr. Nunez. Welcome to the Chapter 15 lecture. Chapter 15 is the Introduction to Managerial Accounting. So in managerial accounting, we focus on meeting the needs of those internal users. So it's always helpful if we start by comparing financial accounting to managerial accounting, because financial accounting is ACC 241. And managerial is the continuation, ACC 242. So in financial accounting, our focus really was on preparing those financial statements, right? Making sure that we are able to record and to summarize and ultimately report in the financial statements all of the transactions and events that a business engages in. But in managerial accounting, our focus really is on meeting the needs of those internal users. So here, in financial accounting, the focus is on the external users of financial information. In managerial accounting, the focus is on management, meeting the needs of those internal users. So typically what you will see in financial accounting, again, if I could try to link back to that, is, we're reporting on more objective data versus in managerial accounting, it sometimes is objective, but it is more often than not, subjective. And in financial accounting, our focus is always GAAP, general accepted accounting principles. We have to prepare everything according to GAAP. That may not necessarily be true in managerial accounting. Again, the focus is on meeting management needs. Now, if we're preparing financial reports that are for management that ultimately may be distributed externally, well, then we would have to prepare according to GAAP. But if we're just meeting the needs of internal users and those reports will never be seen outside of the firm, then GAAP is not our focus. And we're not preparing reports according to GAAP. We're preparing reports according to the needs of management. And typically in financial accounting, we're preparing reports at fixed intervals, for example, a month or a quarter or a year. In managerial accounting, it might be fixed intervals, but also more often than not, it might be on an as needed basis. And then we typically focus on the company as a whole in financial accounting. But in managerial accounting, we also will focus on segments. So it's not just the company as a whole, but oftentimes we'll look at a segment or sometimes just a product or a department or a customer, whatever is consistent with management needs. So let's talk about these manufacturing-based operations. So we focus primarily in managerial accounting on manufacturing operations, but a lot of what we do can also be applied to service-oriented firms, um, retail-oriented firms, in addition to, typical manufacturing firms. So what we're doing is pretty general and generic and can be applied to businesses in general. Most of the concepts that we introduce, we tend to introduce them in the context of a manufacturing business. But again, in many cases, they can be applied to other different kinds of businesses like service and retail businesses. For purposes of this discussion on chapter 15, we're going to look at a manufacturing operation that includes a guitar manufacturer. So this guitar manufacturer, obviously the product is a guitar, and the company is Legend Guitars. And we're going to start with the assumption that, we have a customer that places an order for a guitar. And that means that we've got to acquire the materials that we need, like guitar strings and wood and the guitar bridge. And then there may be some cutting involved and then some assembly. And then ultimately we end up with the finished product. So you want to think of that as kind of the manufacturing process. And that's pretty helpful because a lot of what we do in managerial accounting kind of mirrors this manufacturing process, right? The customer places an order, we've got to add the materials, we've got to add the labor, we've got to add some other stuff. And then ultimately what we end up with is a finished product, in this case, a finished guitar. Now, in terms of what we're going to be doing is we're going to be accumulating costs. We're going to be accumulating costs in managerial accounting and then assigning those costs and reporting those costs and analyzing those costs. So as we progress through this course, that's what we're going to be looking at. Again, accumulating costs, assigning costs, reporting those costs, and then ultimately we'll also look at some analysis of cost or cost analysis. So what is a cost? A cost is it's a sacrifice made to obtain some benefit. And in managerial accounting, costs are often assigned to what we call a cost object. What is a cost object? Well, it could be anything. A cost object is anything that you want to assign cost to. And another description that I like to use is it's anything that you desire a separate measurement of costs for. So a cost object could be a unit of product. It could be a batch of product. It could be a job that you're working on for a customer. It could be a department. It could be a customer. A cost object is just very simply anything that you want to measure costs for. And in this big picture world that we start out with, we're going to accumulate costs based on whether or not they are direct cost or indirect cost. So we're going to accumulate and assign these costs based on whether they are, again, direct or indirect. And what's the difference? Well, a direct cost is a cost that we can trace to the cost object. So let's imagine that the cost object in our illustration here is a guitar. This is, again, a guitar manufacturer. And let's imagine that that's how we're going to define the cost object. It is a guitar. So that's a product, that's a unit of product. So a direct cost is a cost that we can trace to the cost object. And let me also add here that sometimes we say it's a cost that we can trace. And I usually add here, and we choose to trace it. Because sometimes there will be costs that we can trace, but we just choose not to trace them because they're immaterial. But in this case, what we are saying is that we have a cost that is a direct cost because we can trace it. And again, we choose to trace it. But then there are also some costs that we can't trace. So these indirect costs are costs that are not traced to the cost object. We can't trace them, or we choose not to trace them. So again, in this big picture world of cost accumulation and cost assignment, some costs we can trace to the cost object, some costs we can't trace to the cost object. And this, again, this is a pictorial of the descriptions that I just gave you. We have the cost object here, right? It's a product, it's a guitar. And we need to accumulate all the costs that we incur in making a guitar and assign them to the guitar. Well, some of those costs we can trace directly to the guitar. Some of those costs we can't trace. So which costs are we talking about? Let's be more specific. Well, we've got three kinds of costs in a manufacturing operation. We've got what we call direct materials, direct labor, and factory overhead. So let's go back to this concept of direct cost and indirect cost. A direct cost is a cost we can trace. That's what this is, direct materials. A direct cost is a cost we can trace. That's what this is, direct labor. So that means the direct materials and the direct labor are both costs that we can trace to the guitar. All right, so all the materials that we use that we can trace, we call them direct materials. All the labor that we use that we can trace, we call it direct labor. Any other manufacturing costs that we incur in producing a guitar, well, they're not direct materials and they're not direct labor. It's everything else. Well, that's going to be factory overhead. So, for example, if we have utilities, well, utilities is not direct materials and it's not direct labor. We can't trace it to the product, right? You turn the lights on or you run the equipment, you can't trace those costs to the product. Those are costs that are not traceable. They are indirect costs, and they would be here under factory overhead. So the direct materials, let's be more specific. So the direct materials, we like to think of those as costs that are integral, right? They're an integral part of the finished product, and they are a significant portion of the total cost of the product. So those insignificant materials costs we wouldn't include. So if I could try to give you an example here, when you're making a guitar, something like the cost of the wood, right, in making a guitar, a wood guitar, well, that would be an integral or significant portion of the cost. That would be a direct material. right? Or if you were making a television, the cost of the electric components would be a direct material. If you were making microcomputer chips, the silicon wafers would be a direct materials cost. If you were making an automobile, the tires would be a direct material. So again, a direct material is an integral part of the finished product. It's a significant portion, and it's a cost that you can trace directly to that product. Now, let's go back to this guitar example. Sometimes when you make something like a guitar, in addition to the wood, well, you probably have some glue. You got to glue those pieces together. You might even have some screws or nails or some other miscellaneous product that you're using. Well, those are, again, insignificant. They are materials that you use to make the product, specifically the glue, right? Let's focus on the glue. You got to glue those wood pieces together to form that guitar, but you can't trace the amount of glue that you use, and even if you could, you wouldn't want to because it's insignificant, right? It wouldn't be a significant portion of the total cost. It would not be integral. So we might have glue that we use to make the guitar, but it's not a direct material. It would be an indirect material, and it would be factory overhead. And any other materials that we use in manufacturing the guitar, that are not direct, that are not traceable, or we choose not to trace them because they're not integral and they're not significant, well, they would just be indirect materials, and they would therefore be factory overhead. Now, the direct labor, well, again, direct. Direct means that we can trace it to the cost object. And another term that I like to apply here is touch labor. Direct labor is that labor that is physically touching the product during the manufacturing process. So in the course of making a guitar, that is the labor that is cutting and assembling. Again, they are touching the product. So they are directly involved in converting the raw materials into finished products. Again, the touch labor and the cost of those employees, right? That's an integral part of the finished product. And we can trace it. We call that the direct labor. Examples of direct labor. So you have those employees who are cutting the guitars out of the raw lumber. They are assembling the guitar. So again, you got that touch labor. They're cutting, they're assembling, touching the product during the manufacture. If you're manufacturing an automobile, those mechanics that are working on the auto, that's the touch labor. If you're making a laptop computer, those laborers that are assembling the product, that's that direct labor. So again, touch labor, I think, is a very good description of direct labor. Now, let me also add that you probably have other types of labor. For example, you might have a supervisor who is supervising the operation. That's not touch labor, though. The supervisor never touches the product. The supervisor is just in the plant supervising the operation. You probably have maintenance labor. So at the end of the day, when they shut the equipment down, someone's got to come in and take the line apart and condition it and oil it and get it ready for the next shift. They're not touching the product. They're just working on the equipment. So that's not touch labor, it's indirect labor, factory overhead. And there are other kinds of labor that you probably have in a manufacturing operation that's not touch labor. They don't assemble the product. They don't touch the product in any way. So it's indirect labor, therefore factory overhead. So we have our direct costs, direct materials, direct labor, and anything that's not direct materials or direct labor is what we call factory overhead costs. So factory overhead is everything else. And sometimes we call it manufacturing overhead or factory overhead. The point is that it's not direct, right? It's not direct materials. Anything other than direct materials and direct labor is what we call factory overhead. And these are some pretty good examples that we have listed here. So the utilities, the heating and the lighting, so repairing and maintaining equipment, property taxes on the factory building, insurance on the factory building, depreciation of the factory building. All of these costs are manufacturing costs, but they are not direct materials. They are not direct labor. They are overhead. So, if we put it all together, when we talk about manufacturing costs, when we're manufacturing these guitars, We've got the direct materials costs. And the example here is the wood that's used in the neck of the guitar and the body. So the neck is this long thing that you see here, right? That's wood. It's direct materials. The body is what you see here, right? Those costs for the wood that's used is integral. It's significant. And then the direct labor, well, you've got people that are sawing, that are assembling, right? So you've got some direct labor here because they're touching the product. You've got some direct labor here because they're assembling the product. The direct material is that integral, that significant cost. And then you've got everything else, right? So anything that's not here, it's not direct materials, it's not direct labor, it's going to be overhead. The wages of the janitor, the power, or the utilities to run the machines, the depreciation expense, sandpaper and buffing materials, the oil that's used to lubricate the machines, the salary of the production supervisors. These are all manufacturing costs, but they are not direct materials, not direct labor. You either can't trace them to the cost object, or you choose not to trace them to the cost object. So ultimately, all of these manufacturing costs have to be reported in our financial statement. So again, we've got to accumulate all of our costs, we've got to assign those costs, and we've got to report those costs, because ultimately we have to be able to measure and report income in our financial statements. We can't report income in our financial statements, right, on that income statement, unless we've got this number, a cost of goods sold. So on the income statement, the first thing you have is revenue. After revenue, you've got to subtract the cost of those goods that you've sold. The cost of the goods that you've sold is the manufacturing cost, the materials, the labor, the overhead. We need to be able to measure those costs and assign them to any goods that we've sold, and then match the cost of goods sold with the revenue. Why? Because GAAP says so. So here's where we do have to follow GAAP, right? Because generally accepted accounting principles and the IRS both say that we have to match this cost of goods sold with our revenue. So in order to be able to do that, we've got to be able to measure these manufacturing costs. And sometimes we also call manufacturing costs product costs. So anything that is a manufacturing cost is a product cost. Anything that is a non-manufacturing cost is a period cost. Manufacturing costs are going to flow through the balance sheet. And then when we sell the product, they go to the income statement. On the other hand, the period costs, the non-manufacturing costs, go straight to the income statement, and we call those selling and administrative expenses. So if we were looking at the income statement, and it doesn't matter whether you're looking at an income statement for a retail operation or for a manufacturing business, ultimately, we need to be able to report cost of goods sold, right? We can't measure income without cost of goods sold. So whether we are, again, a retail operation, right, where we buy product and then just resell it, we're still going to need a cost of goods sold. Or if we're a manufacturing business, we're going to need that cost of goods sold so that we can measure income, because sales less cost of goods sold gives us that gross profit. Sales less cost of goods sold gives us gross profit. And then we subtract the selling and admin expenses, and we've got income. And here's kind of a complete picture of the financial statements. So we have an income statement here. So again, sales is at the beginning of that income statement. And then we've got a cost of goods sold. And we'll talk more about this little section here, this cost of goods sold section in just a few minutes. But essentially, it's sales minus cost of goods sold, right? We're going to take sales minus cost of goods sold gives us gross profit. Gross profit minus those period costs, the operating expenses, is going to give us income. That's what we're going to be measuring, right? It's a traditional approach to measuring income. Sales minus cost of goods sold gives us gross profit. Gross profit minus those operating expenses gives us income. So essentially what we're saying here is we've got all of these manufacturing costs here. That's what cost of goods sold is. Cost of goods sold is only manufacturing costs. So everything from here to here, those are manufacturing costs. And then everything from here to here, those are the period costs. And again, manufacturing costs, those are product costs. And those are costs that are going to flow through the balance sheet and ultimately to the income statement when we've got sales revenue. And we're going to measure all of these costs on this separate statement here. So all of those costs that are flowing through the balance sheet, are going to go through this, what we call a statement of cost of goods manufactured. So essentially, we're going to measure the materials, we're going to measure the labor, and then we're going to measure the overhead. That's all we're doing, is we're taking all the direct materials, all the direct labor, all the overhead, so that we can measure the cost of the goods that we've manufactured. And that enables us to calculate this cost of goods sold. And again, I'll take you through a detailed example in just a few minutes. So let's look at kind of the flow, the assumption. It's what we call a cost flow assumption. It's how we assume the cost are flowing through our process. So all of these manufacturing costs, right? The materials, the labor, and the overhead. These are all the costs that we incur in our manufacturing operation. So as we manufacture, right, all of these costs have to flow through the balance sheet, right? Everything goes through the balance sheet. All of these manufacturing costs flow through the balance sheet. And on our balance sheet, we have three different kinds of inventory accounts. We've got materials inventory, we've got work in process inventory, we've got finished goods inventory. And these account titles are self-explanatory. Materials, well, those are all the materials that we've purchased. Work in process. Well, those are the goods that are in process. We haven't finished them yet. They're in process. And then we've got the goods that we've finished, right? They're no longer in process. They're just finished. So all the costs for materials are going to be here. All the manufacturing costs are going to be here for those goods that are still in process. So notice all the materials, right, are going to go here, right? When we start production, the materials are going to go into work in process. The labor is going to go into work in process, right? So we got materials going into work in process. We got labor going into work in process, and we got overhead going into work in process. That's our manufacturing operation right here, right? Everything. That's what I talked about earlier, right? All of these manufacturing costs, the direct materials, the direct labor, and the manufacturing overhead, all of it's going into the work in process account when the goods are finished. After we've finished production, then those costs make up what we call cost of goods manufactured, and they go to the finished goods inventory account. So this right here, right, this kind of mirrors that manufacturing operation, right? And the manufacturing costs are only incurred right here. Once we finish this, right? Once we finish manufacturing and we send those goods to the finished goods inventory account, think of that as the warehouse, then we don't have any more manufacturing costs. We can't because the goods are finished. So manufacturing costs are only incurred during the process, right? During the manufacturing process. Finish manufacturing, the goods go here to finished goods. You can't have any manufacturing costs after that. And once the goods are sold, then they go to cost of goods sold. Okay, now let's talk about costs. Let's talk about how we summarize some of these costs and report them. So we have these manufacturing costs. And there are three things that we really need to be able to calculate in order to prepare our financial statements. And on this illustration, I've got the three things that we need to be able to calculate. The first thing is the cost of the materials that we've used. So here, all we're doing is focusing on one, what we start with, right? So we kind of start with some materials that are in the inventory at the beginning of the period, 44,250. That's coming from right there, right? The materials at the beginning of the period. So the materials at the beginning of the period plus what we've purchased. So we've purchased some materials. That gives us what's available, right? So we start with 44,250. We buy 556,600. That means we've got total materials available of 600,850. So the beginning inventory plus what we've purchased, right? That's what we purchased. It gives us what's available. So those are all the materials available. And then at the end of the period, we take a physical inventory and we determine that the materials at the end of the period, that's all we have left is 31,700. So what's available minus what we have at the end of the period gives us what we've used. That tells us what we've transferred into the work in process account. That's how we determine the cost of materials used. Same steps every time. Beginning plus purchases gives you what's available. Subtract what you have at the end, and that's what you've used. So we've got the cost of the materials used. So this is our materials account, right? So earlier I said you got 3 inventory accounts on the balance sheet. This is the first one, the materials inventory. So that's number 1, right? That's the first thing that we need to be able to do. Number 2 is we need to be able to figure out the cost of goods manufactured. Here's where we have to look at that work in process account now. So we're going to approach this in the same way. Anytime you have an inventory account, all you're going to do is start with something, right? You got some kind of a beginning balance, right? Doesn't matter what kind of an inventory account is. It's beginning, plus you're going to add something in, right? So you add something in, and what that leaves you with is kind of what's available, right? Leaves you with what's available. And excuse me while I very slowly write this out. So the beginning plus what you add gives you what's available. Subtract what you have at the end, and that really kind of gives you what you need, right? That's what you've used. And that's essentially what we're doing in all 3 steps. That's what we just did for materials, right? We took the beginning materials, plus we added in our purchases, and that gave us what's available, subtracted what was at the end, and that's what we used. That's what we just did for materials. We're going to do the same thing here for work in process. We're going to start with the beginning. That's what this is. Work in process at the beginning of the period. And where's that? That's right here. So the work in process at the beginning of the period is the 63.9. And then we add something in. What do we add in? Well, we add 3 things in. We add in the materials, we add in the labor, and we add in the overhead. We add 3 things into work in process because that's what happens in the manufacturing process. We add in the materials, the labor, the overhead, finish the goods off, and we've got goods that have been completed. So we've got here the cost of materials that's coming from right here, right? The cost of those materials used is right here. So that number is just kind of flowing down right there. There's the cost of the materials used. And then the labor is given, that's here, and the overhead is given, that's there. So we've got a beginning work in process. We add in materials, we add in labor, we add in overhead, and this is the sum of all those manufacturing costs that we've added. So this plus this equals this. And then we say, well, if you take all these manufacturing costs, right? You take what we start with at the beginning and you add in the cost this period, that gives you all the manufacturing costs that are available, right? Beginning plus you add something in gives you what's available. Subtract the end, that's what you've used. That's what we're doing. The beginning, we add in manufacturing costs, that's what's available. Subtract the end, and this is what we've used, the cost of goods manufactured. So essentially, we've just done the same thing that we did for materials. Beginning plus add in materials, labor, overhead gives you what's available. Subtract what you have at the end. That's what you've used. And now we're going to look at the third inventory account, the finished goods account. Finished goods inventory. Well, finished goods inventory, we're going to do exactly the same thing. Now we're going to say, okay, we have some kind of a beginning finished goods account. It's right here. Here's beginning. So the beginning finished goods account is right there. And we take that beginning finished goods inventory and we're going to add in the cost of goods manufactured as that number, right? So we've got a beginning balance, we add something in, and that's going to give us what's available. And then we just subtract what we have at the end, and the end is given here. So the beginning balance, plus we add in the cost of goods manufactured, and gives us what's available, subtract what they have at the end, and that's the cost of goods sold. That's what goes to the income statement. That's how we're going to be able to measure that gross profit. Sales less cost of goods sold gives us gross profit. Gross profit minus the selling and admin expenses gives us income. That's it for the Chapter 15 lecture. I'll see you next in the Chapter 15 problem solving session. Take care.